When I was working prior to this role and I was making the decision to come to Concora, I asked customers, I asked consultants, I said, why did you choose them? Why are you doing business with them?
We're joined today by Rolando de Gracia, Chief Commercial Officer at Concora Credit. Thank you so much for joining us. Can you tell us about your professional journey and how you ended up in this new role over at Concora Credit?
Absolutely. So my career in the credit card industry started at the beginning of the 2000s. And interestingly, most of those companies have changed names since. I was with a company called Household Finance. When I started there, the company was very focused on big ticket financing, to the likes of Yamaha and Best Buy and companies like that. And the journey that I took there was to kind of shift the company more into more traditional private label credit cards, getting into partnerships with the likes of Menards and Saks, companies like that. Shortly thereafter, they got acquired by HSBC. And it didn't seem to me like it was the appropriate marriage between kind of the world's premier private bank and a kind of subprime specialist in the US. So at the time, GE Capital, if you guys remember that company back in the day, really starting to grow their consumer finance business. And they had at the time one of the largest private label credit card shops, and they wanted to really start to grow more into the co-brand space. So I was able to go there and spend about 7 years growing the US business into multiple MasterCard opportunities such as PayPal and eBay, and also got them into things like Bill Me Later. And it was quite an incredible journey because we also had the ability to grow into multiple countries. And we went from like 3 countries into like 46 countries in that time span until the crisis of '08, when the federal government basically told GE that they had to kind of exit their consumer finance platform in the US. And one of the last projects that I worked on was spinning off what today is Synchrony, one of the largest players in.
So that was the birth of Synchrony from GE
That was
Capital.
the birth of Synchrony. Yeah, it was really the Fed telling GE that they had to exit consumer finance in the US. Little known fact. I went from there to a company called Alliance Data, which
ADS.
was at the ADS, which was going through a similar transformational journey of being a specialist in what I would call very small, specialty retailer private label credit cards. And they really wanted to get larger into big ticket financing and more of your regular co-brand cards. And they brought me in to kind of do the same journey that I had done before to kind of transform the company a little bit. And I got them into things like Caesar's credit cards or the AAA credit cards, just more of the larger kind of co-brand programs out there. And also getting into real big ticket financing, such as Signet and Helzberg. And the company endured quite a great journey through that time period. It was a great ride. I really enjoyed my time there. And then most recently, I've always thought that from the non-prime perspective, still had kind of an underserved market in the sense that a lot of the suppliers or issuers in the space could really benefit from the expertise of entering into, MasterCard or really, grabbing the private label space and taking it into other spaces, where consumers may have life events, not just durable goods to finance. How can we put our products in the hands of them? Whether it's in travel or whether it's in life experiences, like you need a lawyer, and all of a sudden you don't have the $2,000 and you're a non-prime consumer who doesn't have that money in their debit card. The number of financing options in situations like that are not as many. So I thought that there could really be a kind of a pivotal moment in the non-prime issuing space that could really use from some commercial expertise to kind of transform the companies. And that's what led me into Concora Credit about 8 months ago. I was very familiar with Genesis from having worked with them for decades. Thought that it was kind of the right time and place to really take the company kind of into new markets and into new product ventures such as co-brand credit cards.
Sounds amazing, and you definitely are someone who's been involved in GE, which turned to Synchrony, Alliance Data, which later on turned into Bread, if I'm not mistaken, right? Now Concora, which used to be Genesis. And I can't wait to see what you guys are doing next. Let me ask you, since you really are what I would consider to be a pioneer in this world of consumer finance, Rolando, what are the biggest changes that you've seen in consumer finance since COVID-19? And maybe we could connect that conversation also into, the differentiation between second tier or second look and tertiary, right? Because you said non-prime. A lot of people know what lease to own is, but not everybody knows what the second look is. And I think that is really important. So maybe we could connect that into the changes that you've seen within the consumer since COVID-19 and how that has affected the shopper.
Absolutely. So what we noticed during COVID is two big macroeconomic factors occurred. Number one is, people shifted their consumer spending in a material way towards durable goods. Needed more furniture for home, needed a laptop for the kids, et cetera. Some of the consumer spend that we traditionally would see got delayed. For example, people delayed getting married. So engagement rings are now, going through a bubble that didn't happen in 2020. So you had these kind of consumer, spend shifts. The second one is that a lot of the capital that was infused in the economy really allowed some people who were probably non-prime consumers to kind of boost their scores in a pretty material way. And I do think that the least sophisticated prime, lenders were able to put people in products that were probably the wrong products for them. And then eventually that's created what we call the delinquency bubble and a charge bubble that is affecting the prime lenders. So when you think about what I would call the consumer finance space, where you're really kind of financing the event or financing the durable good or financing the sale, the big players there, such as Wells Fargo, TD, Synchrony, Citi, Bread, I do think that they've seen a kind of shift in consumer behavior that is making them kind of lower their approval rates, which really creates an opportunity for those merchants to really bring in other lenders into the ecosystem. So normally that's where companies like ChargeAfter come in, which create a really fantastic consumer experience that these merchants can offer, both online and in store, that allows that consumer who may be able to put up an initial application and give the data elements used for the prime lender to make their decision, and then pass that information to other lenders to kind of make the same decision without having to have that consumer re-enter the information, removing a lot of friction from the process, making it easier for the associates, to put people in a different product. And traditionally, there have been, a move into using something called the virtual lease-to-own product as a mechanism for people to be able to close the sale. No credit needed, no hit to your bureaus, et cetera. Very appealing for a large number of consumers. Having said that,
but not for all consumers.
But not for all consumers. So what we find is that the end expense to the consumer could be as high as twice the cash price. Some merchants are not excited about putting their consumers into a $1,000 product that may end up costing them, $2,200, right? So in between that prime lender and the lease-to-own is where we sit. And it's basically a revolving line of credit that has a slightly higher APR, even though the prime APRs have kind of matched ours at this point, but also some fees, so a consumer is more likely to want to pay a $5 or $10 monthly fee that if they're able to repay that loan in 6 or 12 months, ends up being a lot more economic than getting themselves into a 12-month lease where they end up paying twice the cash value. So that's really what we allow our merchants to offer and what we allow the consumers to select as an alternative financing mechanism when they're getting declined by the primary. The primary will always be the champion product. We're never trying to compete with them. We sit there behind Citibank at Home Depot and they do a fantastic job. We sit behind Bread at Signet. They do a fantastic job. We sit behind Synchrony at all of the Ashley home stores. They do a fantastic job. But for the people that they decline, we offer them a very cost-effective alternative before moving to the lease-to-own product. And I think that has been an incredibly accepted mechanism by both merchants and consumers. And that's where a lot of our success lies, in that second look, non-prime, revolving line product that we offer.
So challenging economic times, challenging economic climate. And as you know, the world of consumer financing is consistently evolving or constantly evolving. So how is Concora adapting, developing your products that you have today in response to technological advancements, and then, of course, the challenging economic climate that we're in today? How do you constantly make your product better and always aligned with what the shopper is looking for?
In multiple ways. So one of the things about our business that may be not as well known is that in addition to being a very, one of the largest, if not the largest, second look private label issuers, we're actually we're the second largest MasterCard subprime specialist. That allows us to do is to really be able to invest in tools, support, customer experiences beyond the initial purchase. So one of the things that we pride ourselves in is the scale of our platform, the expertise where we have, the global call center support that we can give both merchants and their customers. Those investments really manifest their way into how we can optimize approval rates by bringing in, for example, top of the line for prevention tools. We can bring top of the line lists and non-FICO based decisioning, from a data sciences perspective. Scale manifests in the sense that we have 50 people in our data sciences team, and we have 150 people working on technology. Some of our competitors, that's like their entire company. And I think that scale, we're on the top of the line, Fiserv platforms, and we use all of the best toolkits. So I think that's how it manifests in that better customer experience. And then we have a lot of experience integrated with platforms such as ChargeAfter, so that we can continue to develop and supply the best, most frictionless customer experience in terms of enabling merchants to move customers from one prime application into our product in a seamless manner. Spend a lot of money in our marketing. One of the things about our cards is that because it's a revolving line product, once a consumer is part of our ecosystem, we can drive a lot of repeat sales. So about 95% of our customers at a Home Depot, for example, are making repeat sales 8-9 times a year.
Which is huge and very important for a merchant, because if I may, many of the prime installment products out there, the moment that the shopper is done paying back their installment loan, the relationship essentially between the shopper and the merchant, or the shopper and the financial institution, is basically satisfied. Over here, the merchant is able to use that revolving line of credit, right, to continue to bring that consumer back in to maintain that relationship with the consumer.
And the consumer doesn't have to apply again.
There you go. Loyalty,
and they have a dedicated line of credit to that retailer, which makes a change in their shopping decision. I will go to Depot. I will go to Ashley. I will go to Rooms to Go because I already have a line of credit there. And it does create, and even in furniture, we have a 40 to 50% repeat rate. So a lot of the good news about having such a large platform on the MasterCard side, for example, is that we can use all of our toolkit for repeat purchases of lifecycle marketing, trigger marketing, and we can deploy that across the retail base to really enable more purchases. One of the partnerships we're working with you guys on, which we'll be launching soon, it's one of the largest manufacturers of computers in the world, but they also sell printers and they sell supplies. Just think about the ability to go from the $1,500 laptop into the $200 printer, into the ink supplies on a continuous basis. So just having that platform and the ability to really know how to remarket that customer to bring him back to the partnership is one of our key, investment decisions that we make that benefits our partners. So that's how we kind of look into this world where the primes are going to continue to approve less customers. And if you're a merchant, you want to put them in a second look that has the similar fraud prevention, that has the similar scale, that has the similar mobile app support, that has a similar lifecycle marketing. I think that the fact that we're that scale player enables that for the partners. And to your point, they don't have to give their customer to a firm or give the customer to somebody else, or for that matter, a lease product that may not be as well invested in from a customer care perspective and doesn't have the lifecycle marketing experiences that we can offer. So I think that's exactly where we sit and where investment has gone to make it better for the consumer and make it better for the merchant.
So you mentioned a large retailer. I mean, we put out a press release along with that customer a few weeks back. So, leading brands such as HP, right, and Purple have chosen Concora Credit as their second look provider. What is it specifically about Concora that stands out from other near prime? Again, I'm making differentiation to subprime, right? So that make these leading brands, you mentioned Home Depot, right? HP, Purple, continue to select Concora time and time again as their provider, as their partner.
The customer experience that we can deliver, the marketing support that we can deliver, and the overall just kind of capacity for growth that we have. I think that in addition to that is the partnership DNA. The fact that this is key to our go-to-market strategy. When I was working prior to this role and I was making the decision to come to Concora, one of the things that I did is I asked customers, I asked consultants, I asked people that have made the choice to come to partner with Concora. I said, why did you choose them? Why are you doing business with them? And they said they were easier to do business with. We liked how engaged they were. We liked how personable they were. And at the end of the day, culture matters. I've always been a big believer that culture will beat strategy any day. And I think that people want to do business with like-minded companies. And, our DNA is high retail, where CEO used to run furniture stores, and our COO used to, want to be one of the leading leaders at Columbia. So we have a lot of people that were retailers themselves, understand retail, and we've been kind of born from retail, supporting a retail partnership. So I really believe that culture really matters. And it was one of the deciding factors for me to join the firm. And it was one of the deciding factors, I believe, for the companies who have selected us recently.
So Concora remembers to bring in that human element, that human touch, or I like to call it H to H, human to human. And maybe that's something that unfortunately many times is overlooked today in business. I'm really happy to hear that Concora puts that at the core. And that is why merchants are selecting Concora time and time again.
Oh, so retail is detail, right? And
retail is detail. Nice one.
And it's really an engagement vehicle, right? So how the consumer feels about the relationship, are you giving them enough open to buy? Are you servicing them correctly? We know when they talk with a problem, are you present, right? I mean, all these things matter, is the relationship for service digital enough, So I think that the whole package matters, because you have to think about these customers as your partners' customers, and how do you bring them back? And that's really the objective function at the end, more so than just enabling the sale at the lowest possible, cost to the retailer. And, that to me is what makes us, stand out.
So Rolando, can you talk about how merchants and consumers benefit when financing is offered through a platform like ChargeAfter? And how does it affect the merchant's business, and how does it affect the consumer at the end of the day?
No, we think that the role that the platforms like ChargeAfter play in the ecosystem is pretty vital, in the sense that it does enable the merchants to offer a customer experience that is proven versus developing their own.
Sure.
And it is something also that the primary lenders have adopted and accepted, right? They don't want to have to do 12 different integrations with 12 different, second-level providers. Instead, they just do one integration with someone like a ChargeAfter, and then it enables then the rest of the cascade to be selected by the merchants without the primary having to really get that involved, and neither the merchants to get that involved, because if there's one thing that will kill a project is IT resources. And and what we find is that ChargeAfter and others can minimize the lift by the merchant and can make it reusable, so that if for some extent the relationship with the primary or the secondary or the lease-to-own, the tertiary, gets soured by whatever reasons, it's a lot easier for the merchant to switch, financing partners. Obviously, we don't want to get switched out at any point, but understand that in order to stay partners with someone, it shouldn't be because of a technology link you did a decade ago. It should be because you're winning the business every day by offering better service and bringing the customers back into the stores. And that's really what we try to do on a day-to-day basis. And I do think that the enablement that you guys bring is pretty material. And that's just on the application side. I mean, you're also helping them with being a merchant acquirer, which, by no means you're going to find really 15 different lenders out there who are very good at merchant acquiring, and you can offer them at least a consistent experience across the lender set that they may choose.
I like exclusives, Rolando. So do you have any other exciting projects that you're working on right now that you can or would like to share?
Share
it right here for the first time.
I really don't, I'm not going to name names, but one of the things that we're finding momentum in is the fact that historically, there have been players for whom the second look products have been private label to a co-brand, yet we're finding that, a co-brand second look to a co-brand is something we're spending quite a bit of time being successful on. The second one is that, we're trying to take our line of credit into verticals besides durable goods, where we're going to be launching soon products think about consumer events that require a lot of capital from a consumer to get it done that they may not have in their debit card, right? And it could be things beyond medical, which is pretty well permeated. But we're taking the thinking and saying, what else can happen in someone's life when all of a sudden they need $3,000 and they don't have the $3,000? And how can we offer financing?
Home improvement.
Home improvement is one,
Yes.
maybe an attorney, maybe you need something
Sure.
else. There are moments like that, like all of a sudden there's an educational requirement you can't fund. So we're really starting to think a little bit outside of, the durable good and finding some good traction, but obviously we continue to focus on our main core verticals and winning, so there are some people out there who just have a primary and a tertiary, don't have a second look, and we're getting quite a bit of success in both furniture and other more traditional verticals where we're finally able to persuade those merchants that perhaps offering that consumer an alternative between paying 2.2 times cash price and or the primary is a good idea. So those are things that we hope to be launching in the first quarter.
Rolando de Gracia, Chief Commercial Officer at Concora Credit. Thank you so much for your personal story, and we can't wait to see how this story continues to evolve.